Hey guys, welcome to another video from the Financial Controller. In today's video, I'd like to discuss one of the questions that interviewers love to ask when it comes to accounting and finance interviews, which is, what's the relationship between the three financial statements? And so I'm going to lay it all out for you here so that when you are in an interview and you're asked that question, you're able to address it. So let's get into it. Here are the three financial statements. So we're looking at the P&L or the income statement, the balance sheet, and the cash flow statement. So typically in a P&L, you'll have revenue minus cost of goods sold equals gross profit. And then you'll have operating expenses. And then that yields to net income. And then on the balance sheet side, typically you have cash and you have AR or accounts receivable, and then you have other assets. Equals total assets. And then on the other side of the balance sheet, you'll have the liabilities and the equity. So for liabilities, mostly you'll have accounts payable, you'll have other liabilities, and that's total liabilities. And then you'll have equity, which is shareholder equity. And then obviously total liability plus shareholder equity will equal to total assets. And so on the cash flow statement, let's lay it out real quick. It will include net income, and then you'll have non-cash items such as depreciation and amortization. And then you'll have cash from operations. You'll have cash from investing, and then you'll have cash from financing, and that will be total change in cash. And so now we can talk about the relationship between the financial statements. So from the P&L, your revenue will drive AR. So when you sell an item, mostly on credit, you are then increasing AR. As AR gets collected, that goes into cash. Then the next thing to talk about is cost of goods sold. As you buy merchandise or buy goods, you are increasing your accounts payable. When you then pay off accounts payable, that comes out of cash as a reduction. Then you have gross profit on the income statement, minus then operating expenses. You have net income. Net income will then flow into shareholders' equity in the form of retained earnings. So this describes the relationship between the P&L and the balance sheet. Now, the same can apply to the cash flow statement. The net income that results from operation will then become the beginning of your cash flow statement. And then, other items that goes in the income statement, such as depreciation and amortization, will be then subtracted out of the equation in the cash flow statement, because depreciation and amortization are non-cash. You're not spending any actual money. And so that's the non-cash item. Then cash from operations, that will be the fluctuation in accounts receivable. So you have AR, period over period, going either up or down. That will be going into cash from operations, as well as accounts payable. That will also, fluctuation up or down, will go into cash from operations. If accounts payable, for example, goes down, that means that cash went out the door. You paid off some of the accounts payable that you have. And so that feeds into cash from operations. Next, you have cash from investing, and that would represent any cash that you're spending on capital expenditure. This will come from other assets. So, for example, if you purchase equipment and that goes into machinery and equipment, so that will be this item here that will drive cash from investing activity. The next item is cash from financing activity, and that represents if you've acquired new debt, you've taken on a new loan, or you paid off a loan, or the actual interest or the service on that loan, that will go into cash from investing, and that will be coming from the P&L into here. And the total of these activity will be the total change in cash.
Fuck it. Bring it in. Come here. Bring it in, you bastard. Come on.
And so this is the relationship between the P&L, balance sheet, cash flow statement. Interviewers nowadays love to ask this question in an accounting or finance interview. So now you know how the data flow from the three financial statements and the relationship, and you're able to address that question. If you like the content of this video, please give us a like or share this video with someone that you think will benefit from it, so you can help my channel grow, and see you in the next video.